I'm Doug Lopez, Senior Portfolio Manager at Aristotle Credit Partners. Today, we're going to discuss ESG investing in corporate bond portfolios. Why do we think environmental, social, and governance factors are important when evaluating companies, and how do we approach ESG investing at Aristotle Credit Partners? We believe it is fundamentally logical that companies who possess strong governance, who foster positive social interactions, and who are environmentally conscious truly epitomize well-run organizations that will prove to be solid investments over time. Our overarching philosophy at Aristotle is to invest in well-managed businesses, identified through detailed analysis with a long-term perspective. Assessing the quality of corporate governance is a key element of our analysis. We need only look at the havoc wreaked on investment portfolios by poorly governed companies such as Enron, WorldCom, Tyco, more recently Valiant and Volkswagen, to see why good corporate governance is essential. Companies that possess poor environmental and social records are also destined to experience financial problems as a result and prove to be poor investment performers. Importantly, responsibly managed companies are what the marketplace and investors are demanding today. Consumers are increasingly focused on and loyal to those companies that exhibit higher ESG standards. Equally important, our investor base is growing vastly more interested in responsible investments and the more proactive form of ESG investing that we can deliver at Aristotle. We are a proud signatory of the UN's Principles for Responsible Investing. This framework of best practices was developed in 2005 to help asset managers incorporate ESG factors into their investment process with the goal of encouraging companies across the globe to engage in socially and environmentally responsible business practices. So let's talk a bit about how fixed income investors such as ourselves can make an impact through ESG investing. There is a misconception in the marketplace that only equity investors can influence corporate behavior via proxy votes and such. While debt investors have always been key to corporate success, we would argue that our influence has risen significantly in the past few decades as corporations have consciously chosen to operate with more levered balance sheets, thereby increasing the importance and influence of debt investors. This is especially the case within high yield or below investment grade companies, where many businesses are primarily funded through debt. We are often asked about our specific approach to ESG investing at Aristotle Credit. Our ESG targeted strategies involve a systematic approach that quantifies and rates individual companies. Our investment portfolios are focused on investing in the highest scoring companies whenever possible. Let me briefly walk you through our steps for ESG portfolio construction. As we always have, we begin by constructing a model portfolio incorporating key investment themes, such as portfolio quality, duration, and industry and issuer weightings. These are derived from our blended top-down and bottom-up investment process. Next, we conduct negative screens on the model portfolio, where industries such as coal miners and tobacco and select individual credits are eliminated from portfolio consideration completely. We then employ positive screens on the remaining companies, focusing our investments in those companies that disclose material ESG data and information. Finally, we score current data and trends relative to peers using internal and external sources such as MSCI. But then how to approach an industry such as energy, where environmental concerns are high, but cannot be substantially eliminated or substituted for because it represents an economic and societal necessity, and also accounts for a material percentage of the high-yield market. We believe that the most responsible methodology for our ESG strategy is to limit the industry allocation to that of the benchmark, while favoring those companies with the highest ESG scores. Whenever possible, we look for energy companies that disclose the most ESG information and possess solid governance practices, favorable labor relations, demonstrated efforts to contain their environmental impact, and peer-leading safety records, among other considerations. We believe investing in this manner can positively influence companies that may otherwise be ignored by solely relying on a negative screen. So as you can see, our process at Aristotle Credit integrates ESG research and traditional credit analysis in an attempt to identify companies that meet our investment objectives and provide the greatest positive ESG impact on the portfolio. We believe our approach can lead to improved risk-adjusted returns while also encouraging companies within the corporate bond market to adopt responsible business practices.